So we'll go ahead and get started. If you have any questions during this presentation, just put it in the chat box and we'll do Q&A at the end. So if you've got something, just put it in there. And then at the end, Rob, if she's still on, we'll help facilitate that. Otherwise, we'll just do Q&A then. I've got some Q&A during the presentation. Maybe that might answer a question that you have before the end, but if not, I'm always available. Mike is not able to be on the call today. He's got some technical issues happening. So it's just gonna be me and Ra. Basically today, what I want to talk about are the lending changes and a little bit of market update, some statistics to help you navigate conversations with potential clients, whether they be buyers or sellers, and talk about some of the lending changes that we've got coming up or some that have already taken effect and what we see in the future maybe that's going to happen. I spent a lot of time over the last few days compiling copious amounts of data because there's so much out there right now. A lot of stuff that's skewed a little bit, that's maybe not quite accurate that we're hearing in the news. So I did all that. And then I realized, Mike did a really good job of going through those statistics last week on his call. So I'm not going to go through all of that again because it's just basically going to be duplicate information. I'm going to give you my thoughts from the lending side as a lender, what I'm actually seeing. Between me and all of you guys, we're the boots on the ground. We're the ones out there that really know what's going on in the market, despite all of the headlines and despite people's misconceptions about what's happening. And I've said it so many times, and I'll say it probably a million times more, that, we are the experts in our field, in our areas, in our communities, and we need to position ourselves as experts so that people trust us, because ultimately we want to be a part of someone's realizing the dream of homeownership. I know that sounds maybe cheesy. It's been said a trillion times, but it truly is the American dream. A lot of people that rent right now feel like they can't attain homeownership. And it's really frustrating, right? Because we know that no matter what's going on in the market, if you can afford to buy a house, if you can make those payments, you've got your down payment money, or even if it's a gift, you've got that, then it's always a good time. We never want anyone to stretch themselves, be in any kind of predicament that would make it hard for them to make payments, things like that. But there's a lot of programs out there. There's ways to get interest rates down. It's not doom and gloom. It's not 7.5%. It's not 7% that you see on the news. It's a lot better than that. And I think that Golden One has positioned themselves and for us as loan officers to be successful this year in a time where a lot of people think that it's just crashing and there's doom and gloom everywhere. Mike talks about it as well. Media headlines are one thing, but what's the actual facts? What's the truth? I believe Bertrand Russell is someone who I have his quote written on my board, and it says, look only at the facts. And that's what we're going to do today, is we're going to look only at the facts. We can talk about feelings and things like that, but we're going to look at facts, things that you guys can take with you in conversations, when you're out there in your community, whether it be, your church or your maybe your kids' ball games, or just your group of friends, book club, wine club, whatever you've got, poker club, things that you can, talking points that can help you, first of all, understand the information and be able to articulate it to people so that they see you as someone to trust, number one, and someone who knows what's really going on. Okay, so let's get started. The agenda today, we're going to talk about market update, loan limit increases. I'm going to give you some examples based on the loan limit increases that might help you be able to close more loans, because you've got a better offering than someone else who may not understand all the changes and what you can and can't do. Golden One's offering a $3,000 lender credit for all purchase borrowers that have an application between now and the end of March 31st. That means that basically no fees to Golden One, and you have a couple of thousand left over for appraisal costs, maybe it contribute a little to the homeowner's insurance. I'll get into that later. Lock and shop program, I spoke about that a couple of weeks ago, I believe. Talk a little bit about that. Golden One has some updated guidelines, some niches that I want to go over with you guys that set us apart from other lenders. I'll talk about reserves and rental income, because that has changed a little bit for the better. And I'm going to talk about real briefly residency and visa status, something I say at the end of every call, just to kind of keep it in the back of your mind. One little quote I saw as I was doing all of my research for this call today is, and I really like it. It's, for many homeowners, their house is not only a shelter and store of wealth, but a source of family esteem and civic pride. For millions of renters, attaining homeownership status remains the hallmark of achieving the American dream. So, that's kind of how it's always been. But like I said before, there's some misconceptions out there. So let's work on 2023, partnering together to help more people realize the American dream. Okay, market update. So basically, this is going to be pretty, this is basically as of this morning, what's going on in the market. So this particular slide's not going to give you the past year or two or whatever, but, our big thing right now is interest rates have gone up so much, so quickly. Inflation's out of control. People are spending a lot more money on, food items. Gas has been outrageous for several months. It's now coming back down. So basically, when I look every morning, when I look at the market update, I can see whether it's a time that we should lock or maybe float the interest rate. Right now, we're kind of in a floating pattern. We saw interest rates come down just a little bit last week. They'd gone up and then come back down a little bit. Now, when you see on the news just general articles that talk about mortgage rates, of course, they're going to talk about national averages, right? It's never going to be exactly what's happening in your neck of the woods. So that's why you wouldn't want to come to me and say, hey, Jody, what are rates doing? I've got this client here, there. I know that some people have asked me to send rate sheets every day out, but the issue that I have with that, and if the one person is on here that asked me, this is kind of why I haven't done it. Those rates are great for educational purposes. You can find them online, even at Golden One's website. You can go to any lender's website and see generic rates. Most of the time, those rates are not what your client is going to actually receive. For me to give someone an actual rate quote, I really do need to have a detailed conversation with them. I'm not just going to say, well, 6.5 today or 5.5 today or whatever. There's a lot of conversation that has to happen for me to give someone a rate quote. People are very rate sensitive and very rate focused. There's a whole lot of things that go on with a real estate transaction that I'm trying to help people understand. There's a lot more to it than interest rate. Yes, that is very important. It's what you're going to be based, your payment's going to be based off of. Let's look at it, look at options. But I don't just say, well, today on a 30-year fix, we're at this rate, or we're on a 10 arm, we're at this rate. So I have plenty of time to talk with your borrowers, even if it's just a, hey, I may not buy until the summer, just kind of want to get an idea. Have them give me a call. No problem at all. What we did see this morning is the CPI report came out. That's the Consumer Price Index, and it showed that inflation has gone down just ever so slightly, 0.1%, but that's a lot better than it going up. So we're moving in the right direction. We have a long way to go and a short time to get there. That's it's country music lyric, but we have a short time to get there in a sense that we got to have some transactions this year, right? We want to see our communities grow and have more homeowners than we did this time last year. So going in the right direction. There's different belief systems out there on where rates are actually going to go in the immediate, today. I would say if I had a purchase contract come in today and I gave them a rate quote, I would say, well, I know you're under contract. Maybe it's a 21-day close or a 30-day close. Give it another day or two. Let me watch the market for you to see when we should lock. Just because you have the contract doesn't mean lock it and go. It means you now can lock. So we want to look at strategy. When is the right time to lock? I do get a notice every morning of what's happening on the market, and it gives me a good indication of, should we lock or should we wait? In regards to projecting interest rates going forward, a month, 2 months, 3 months, it's really going to depend on inflation, right? That's the biggest factor right now that's impacting mortgage rates. And I'll get into that a little bit more later. The Mortgage Banker Association, something I check on relatively often, is they've released the mortgage data application for last week. we kind of knew this. Purchase contracts are down about 0.5%. Okay, that's normal for this time of year. Through the holidays, people are not really working on getting approved for mortgages. Sometimes people buy homes during the holidays. It's technically our slowest time of the year. It's time for us to take a break, relax, spend time with family, and then plan for the next year's success. So with that, purchase has gone down now 44% year over year. That is not a surprise at all, right? We know that that is an accurate statistic, and we see why. It's not a mystery or anything like that. Interest rates decreased from 6.5 or 6.58 to 6.42, about 1/8 of a point. That's what I've seen. This time last year, I could probably go back and look at that recorded call. I was saying to you all, you got to get a contract in now. You know, we're at 3% still. People can buy more house right now. Please, let's go. And I have a lot of buyers that just didn't make the move yet, and they waited, and, you know, they're at 5.5% or 6%. It is what it is. There's nothing that you and I can do about the interest rate environment except help educate our customers on, you know, why is it this way and what do we think is going to happen in the future. Okay. Let's see, refinances were up a little bit, about 5%. And I think the reason why is because people are tapping into their equity a little bit. Maybe they were on an ARM that's set to adjust and maybe going back on another fixed period ARM. So if you took an ARM out 7 years ago and you were at, you know, 2.5%, and now you're going to adjust and maybe it's 7.5%. Typically ARMs have a 5% cap on the first adjustment. Well, who wants 7.5%? Let's put you on another 7-year, 5.5% or 5.25, whatever it is. It's still a lot better. So I think that that's one of the things that's happening, and people pulling out a little bit of money because equity is on the rise. I'll talk about that later as well. Okay, so just a couple of things that I've gotten from people lately, questions that I wanted to run by you guys as we talk about the housing market update. I get this quite a bit, and you may get this as well. Will the housing market crash in 2023? I get that a lot, that question, but I also get people saying the market's going to crash, it's going to tank, and I'm just going to wait. I'm going to wait for home prices to go down and interest rates to go down. Well, you know, if you've been in this longer than a couple of years, or maybe even just 6 months, if you've done the research, you know, that's not typically going to happen. We're not even remotely close to a mortgage market meltdown or mortgage crash, housing market crash like we were in 2008. I'll talk a little bit more about that later. Several reasons why that is. One is because homeowners have built up significant equity. So the second quarter of last year is the most recent reporting I have on it. And homeowners across the country have about $3.6 trillion in equity. Okay, so the likelihood, even if someone is facing, you know, a hard time, maybe they got laid off, or, you know, the impacts of COVID is keeping them from being able to manage their finances or make their mortgage payment on time. Banks and lenders are working with borrowers. If you've been affected by COVID, you know, you call your current lender and say, this is what's happened, and maybe they'll give you a 2 or 3 month reprieve. Each lender has their own little set of rules. And, you know, what's going to happen to the balance owed, there's different options, but we're not seeing lenders say, well, that's too bad, and, you know, oh, well, or saying, you know, we gave you 3 months and now you're on month 4, make your payment again, and now all of a sudden catch up, you know, the many thousands of dollars you're behind. They're not doing that. There's lots of options to help keep people in their home. Lenders do not want to foreclose. That is the very last option that a lender wants to take on a borrower that's delinquent. The homeowners that closed in the last couple of years, basically March of 2020 to about March of 2022, April-ish, maybe even into June a little bit, the average rate, even on a 30-year fixed, is about 3%, and some under 3%. I know in March of 2020, I put in about 10 million in refinance applications in a couple of days when the market completely tanked, and I was at 2.875 30-year fixed jumbo loans, you know, $1.5 million, $2 million loans at 2.75. what are those people going to do? Do you think they're going to sell right now and then take a new mortgage of 5.5%? Probably not. They're going to stay in that home, or at least keep that home, not really going to sell it, right? That's just about free money. So, one of the strategies I would say as agents, especially if you're a listing agent, is, okay, those people may not be selling their homes right now, okay? Normally that close into buying, what is the average, 5 to 7 years people stay? But one thing you can maybe talk with them about is, okay, well, that's great. You've got a wonderful rate on this home, makes sense that you would want to stay. Now, you're all set, owner occupied home, you've got a great rate. What else can we do now? How about investment property? How about a duplex or a triplex or a quad? Just because they're not going to move or sell their home right now doesn't mean that they don't have options. There's still a lot of things that you can bring a value to someone, even if they've got a super low rate currently. Lending guidelines are nowhere near what they were in the early 2000s, where basically if you had a heartbeat, you could get a loan. I was basically started my mortgage career in 2006, real estate career in 2003. So I've seen different fluctuations in the market, and it's nowhere near, it's not even close to what we saw previously. I think that there's still maybe emotional effects of that people are still hanging on to. It takes a long time for lenders to build back trust with consumers after something that happened that was so horrible for so many Americans, just losing their homes and these incredibly horrible loans that they were in. Thankfully, I never originated any of those, because when I started, I think we had 2 months of those crazy guidelines, and then it all shut down and everything was full doc, tax returns, bank statements, W-2s, none of this stated income, stated asset stuff. So that's another factor that's going to keep this housing market from a complete meltdown like it was before. Why has it slowed down so much? No secret, inflation has impacted affordability. This all stemmed from the pandemic. This probably wouldn't have happened had we not had COVID-19. So basically, when the Fed came in during the pandemic to try to help the economy, I mean, everything was going, kind of sideways really quickly. Remember it was March, middle of March, we were on a 45-day quarantine, and it was like, oh, okay, 45 days, that's awful, but we'll be all right. Maybe we'll come out of it in a month and a half. And then here we are going on year 3. And, there's other variants out there that are causing issues. So COVID is still here, although it's, so much better than it was before. And we have our vaccinations that are helping people stay healthy, but it's still an impact. Interest rates last year from March, April, May or so on increased quickly and went higher than most economists anticipated. I went back and looked at some of the slides that I worked on last year, and one of them yesterday caught my eye, where some of the financial experts were predicting that mortgage rates by the end of 2022 would be 4.5%. And we were all like, oh my God, 4.5%, that's horrible. Well, it didn't go to 4.5%, right? It went to 7%. So that was crazy. And it was a tough year for a lot of people. But now it's a new year, right? And we've got some changes. We've got some things that can help you guys be successful. Inflation, job losses. It is no secret here in the Bay Area that some of the tech companies are laying off. I'm not an economist or anything like that, but I can see what's happening out there and kind of develop my own theory. I think that there was a lot of hiring happening during the pandemic, with tech companies needing to basically keep up with demand, especially Amazon. I think probably everybody in the country ordered from Amazon during the pandemic. So they hired a lot of people, and now they can't sustain that level, and they're having to reduce their workforce to more normal levels. So it's awful. It's awful anytime anybody loses a job. But I think that that's why. So it's not that Amazon's shutting down, Apple's not shutting down, and Tesla's not shutting down. Right. But there is the ebb and flow of the market. Real estate is a constantly moving beast, right? It's never the same thing for an entire year, or even from month to month. So it's always moving up, down, things like that. And we have to work with it, right? Housing affordability is the big thing that you probably hear a lot about in the news right now. 57% of renters and 25% of homeowners spend more than 30% of their monthly income on housing. That's down 3 points and then up 1 point, respectively, from last quarter. Okay, so it went down and then now it's back up a little bit. 57% of consumers are concerned about making housing payments. You know, there's a lot of fear out there, of course, with concern increasing among renters and homeowners. Okay, so even renters are feeling like, you know, they're getting laid off. Maybe they're going to have issues making their payments. 70% of renters, 44% of homeowners are concerned about making the housing payment. That is a 7% increase from last quarter. It could be, even though inflation's going down a little bit, all of last quarter, it wasn't quite there. So people are more concerned, especially the holidays. You know, you tend to, end of the year, you tend to kind of analyze what did you do this past year? What have you made so far? How do you feel like the next year is going to be? So I think that may have played a factor into why some homeowners and renters are feeling, you know, concerned about their mortgage payment. However, 21% of renters are likely to buy a home in the next 6 months. That's a 2% increase from last quarter. So that's good. That's positive. That means that there are some renters out there that are ready, willing, and able to buy. We have to find them. Only 14% of homeowners are set to sell in the next 6 months. We definitely anticipate that there's going to be still a shortage of housing. That played into affordability even during the pandemic, even when interest rates were 2.75, 2.875, 3%, there was still a shortage of housing, right? The people that did sell made a lot more money than if you sold right now. But you know, what are they doing with that? They already bought another house and they've got a 3% interest rate if they bought right away. So they're probably still going to sit on that. 17% of homeowners likely to refinance. Again, I think that that's mostly going to be because people were on ARMs that are adjusting and things like that. I don't think that it's people are refinancing because of interest rate alone, meaning, you know, they got a 30-year fixed at 3. Why are they going to refinance to 5.5? It's not happening. We are seeing an uptick of home equity lines of credit. Those applications have skyrocketed, actually. So people are wanting to tap into their equity, but not wanting to touch their first mortgage, which if you've got a really good rate, don't ever touch that unless you sell, of course. This is all from Freddie Mac's Market Insights. About 2,500 individuals of various age, gender, ethnicity, and religion were polled between November 8th and November 10th of last year. So that's where those statistics are coming from. Excuse me. Try my phone. Okay. I don't want to deep dive into or get too technical into the 10-year treasury and how that impacts mortgage rates, but you can see on my chart here to the left, the 10-year treasury yields and the 30-year mortgage rates, they all coincide. Look, this is from January of 1990. We were over 10%. Actually, can't tell if that's, let's see, the mortgage rate is what's blue, and then the treasury is what's red. So 30-year mortgage in the 90s was, you know, 8 or so percent. And then it went down. 1994 went down, up again in 96. Okay, so it's a steady trend going down, and then we see it now coming back up. So from 1990 to current, that's a generation, you know, in the late 80s and early 90s that were born. They're now able and ready to buy a house. So they've never seen the rates that those of us that are a little bit older have seen. So when we talk about, oh, I remember in the 80s it was 17%. Millennials, not Gen X, because it's me, but Gen Z, all those, they never really saw those rates. So this is what we want to show them. Not something that happened in the 80s. That'd be like me looking at what happened to rates in the 50s. It really doesn't impact me, but this is a more accurate chart, I think, that you can take a look at, because it speaks to basically when those guys were born and then up to being able to buy a home. If you look to the right, we won't get into spreads and what that means, but I do want to point out this. Now, again, this is from January of 1990. We look at that all the way to January of 2022. There are 2 reasons that we had an abnormal spread, which of course, you know, hiked interest rates. And the first, from 1990 to 2022. The first was when Lehman Brothers filed bankruptcy and everything went down, mortgage market meltdown. Okay, it happened then and didn't happen again until COVID, right? So this is something I think to throw in the back of your mind. If you really want to get technical, you can deep dive into it if you want. I don't, if you're not super into economics, you don't want to be too technical with your clients. But this is the hope that this gives me is says, well, since 1990, we've only had two major events that have happened that have caused the mortgage market and the real estate market in general to be a little bit shaky. It was the mortgage market meltdown, which we don't think will happen again. I don't know about what's going to happen in 100 years, but I don't believe in my lifetime we're going to see that happen again. Underwriting guidelines are not going to go backwards like that, where it's putting people in very risky loans. And then, of course, COVID-19. You can say we can anticipate it. You can come up with plans and things like that, contingency plans, but you don't know exactly when it's going to happen. So when this all shakes out, COVID is in the past, and we can talk about it. It thankfully is something that's not currently in our lives. When it's in the past and the markets, levels out, I think we're going to be fine. We're going to go back to more normal levels. 3 to 6 month housing supply, interest rates in the 30-year fixed 4.5% to 5% is where I want to see it. If you've got clients that say, well, I'm going to wait till it goes down to 3%. That's really not likely to happen unless something, awful happens in the world. I don't really anticipate that, but you never know, right? There could be wars, there could be all sorts of stuff. So yeah, there are some things that can happen beyond our control and beyond things that we can anticipate. But looking back to understand the future, this gives me pause to say, hey, it's going to be okay. Rates will go back down. Affordability will still be an issue for some people in some parts of the country, but how can we overcome that? And, hopefully with the calls that I have with you guys and that Mike has with you guys is helping you guys understand what's happening and be able to talk about it effectively to your clients. This is current 30-year mortgage rates. This is going to be from 2016 to 2022. So just in the last few years. Take a pic of this slide so that you can show it to your borrowers when they talk about, I want to wait for rates to go back down like it was before the pandemic. Fine. Before the pandemic, you can see in 2013, 30-year was, what is this? A little over 6.5%. That doesn't seem quite right, does it? 30-year average. Well, that's the chart from Freddie Mac, so I'm not going to argue with it. But you can see here that the last time rates were in the threes it was during the pandemic. This is showing that in 2016 it was about 3.25, and then all the way up to even touching a little over 7%. I think that the year here might be a little off, but I'll have to double check that slide. But anyway, I don't think rates are going to go back into the threes anytime soon. Historical mortgage rates, like I mentioned before, Gen X is in some of the later generations have never seen rates as high as we've seen them. If you're Gen X and older, we were around in the 80s, right? But we weren't taking mortgages out because we were in elementary school. But we still heard the stories from our parents about interest rates being in the teens. So take a pic of this if you'd like. Again, this is all from Freddie Mac. There's a company website called themortgagereports.com. I get a lot of my data from that site. If you guys ever want to play around with it, go ahead. It's got a lot of interesting data in there. Now, home price scenarios. These are projections, okay? So basically, this company, Pulsenomics, they put out a survey, and they've won awards for the survey. Some of the economists, you've got financial guys, you've got real estate people in there, just leading industry experts that give their projections of what they think is going to happen with home prices. So these are the scenarios. We've got super, super optimistic at increase by 2026, end of 2026, of 46.5%. That's a little too generous for me. I tend to be uber conservative. So I'm going to go to the pessimist side. I'm not typically a pessimist in my daily life, but when it comes to this, I would rather underestimate and then have a happy client, in 3 years that call and say, wow, we did go up 20% in our value. So I'm going to probably recommend that you look at the 10%. Although you can see this chart here, we've got several different projections here. The average annual growth is going to be 19.4. Now this is just for the next 3 years. So this is a positive chart. I like it. This is from Zillow Home Price Expectation Survey put out by Pulsenomics. Going forward, like I mentioned before, the impact of COVID-19 on the housing market is still here. It's going to be here for a little while. It's not going to go away as soon as we don't have another variant come out. We are seeing that lenders are getting out of the business. I don't know if you guys work with anybody at Wells Fargo. They are exiting the mortgage business. They are exiting the correspondent business. And basically what I've read was that Wells Fargo's got to kind of regroup here. They've been hit with millions and millions, if not billion-dollar fines for some really awful practices that they had at their banking centers with, getting people signed up for accounts that they didn't even know they were getting signed up for, and some other stuff that happened. So they're seeing fine after fine. So they're exiting, probably going to regroup, maybe pop back in when things get better, not sure. But that's a big deal because Wells Fargo is a big heavy hitter in the mortgage business, especially here in my area. I have friends that work there that are now looking for places to work. Union Bank has been bought out by US Bank, and they're closing the doors there. Union Bank, a lot of lenders sell to Union Bank, like correspondent lending. So that's going away, and they'll be now working with US Bank. Per my sources, Union Bank is not going to hire the loan officers that they currently have to US Bank. They were supposed to, but they're not going to. So if you've got a loan officer you work with, it's at Wells or Union Bank, or US Bank even, or any of the other lenders that are shutting down, and they're interested in going somewhere else, I'd recommend a credit union. I love it. You can have them give me a call if you'd like. What's happening with Golden One, right? So that's a concern. If I start seeing mortgage companies go down, I'm going to say, well, I'm a credit union. We do a lot of other things other than mortgage, but what is happening? Because I don't want to lose my job, and I still want to be able to produce and serve my community and my customers. So the difference with Golden One that sets us apart from a lot of other lenders out there, if not most, is that we're a nonprofit. Credit unions are nonprofit institutions. We are not tied to shareholder requirements or demands. We're not looking at stock prices to see, well, how should we align our offerings to customers based on how much money our shareholders want to see us make? What's the stock price and what do we need to do to get there? We're not like that. Golden One being a nonprofit, of course, we do make a profit, right? We're not going to be in the red every year. We want to be in the green. But what happens to the profit after all expenses are paid? It goes back to the members in an annual dividend. In 2019, that annual dividend was $20 million spread across a little over 1 million members that we had back then. We have a lot more members now. So it goes back to the member. I like to say, when you do your loan with me, you become a member of Golden One or any credit union, but especially with me, you become a member and you can put money with us. You can, if you want to we'll open an account for you, but if you want to bring your whole entire financial portfolio to us, that's fine. We can do that. And then you'll be subjected to a higher dividend and, someone that's got maybe $50 in with us. So that's a great thing that we do. However, our businesses and offerings are not driven based on that number. We do retain a lot of our employees. We did shift about 13 employees recently out of mortgage. 10 of them went into other positions with Golden One and 3 left. I think a couple retired. So we don't really do reduction in force like a lot of lenders do, or a lot of companies just in general. We're very employees centric, and we care about our communities. And so we are very also conservative. So during the pandemic, even though refinance volume tripled, it skyrocketed, we didn't hire a ton of people and then knowing that this is not something sustainable, and then we know we're going to let them go. So we did it very moderately. We even had a few weeks there where we weren't even putting loan applications in for refis because we wanted to get the pipeline under control. So we're very conservative in that sense. And although that kind of stunk for 4 or 6 weeks, it enabled us to be more stable in the long run. All right. A little bragging point here for Golden One market share from January 22nd to September 22nd in California. Golden One was number 12 of all lenders. As you can see, Wells Fargo is number 1. So that's going to shift, of course, when they fully exit. Bank of America, PNC, Rocket, US Bank, all these guys that you see and you've probably worked with in the past, there you'll see Union Bank in there. That's going to go away and absorb into US Bank. Another reason, just on a side note, that lenders are getting out is because for the past, for 14, 15 years, we've been in a refi environment. Okay. And even though rates went down during the pandemic previously to that, we were still refinancing people. So a lot of lenders, they did mostly refinance business. A lot of loan officers basically lived off refinances for more than a decade. I used to do a ton of them. But when I left Chase, and that was in March of 2020, and came to Golden One, I thought, well, I'm doing a complete shift in my career by leaving a big bank and being fed leads to now self-source business. Well, self-source business is going to be purchase business. Okay. Another reason Golden One's doing so well is because we focus so much on purchase, getting purchases closed in 21 days. Refinances now are 30-day closes. That used to be 90 previously, but we're not seeing that many. So that's why. So another reason some of these lenders, and a lot of them smaller shops, are getting out of the business is because refinances dried up. Probably we'll see a refinance boom here in the next year or two, I would imagine, for the people that are buying now, that bought June of last year all the way to maybe June of this year, or even the end of 2023. Those people will be refinancing when inflation is under control and the economy bounces back from that. Mortgage rates will go down. Historically, they have, going into a recession, most likely, we're not already there. When recession happens, mortgage rates go down, and then we'll refinance. But I don't believe it's going to be anything like what it was the past 10 years. Just the sheer amount of people that will be refinancing is a fraction compared to what it was before. Okay, let's talk about loan limit increases. This is, I think, my most exciting part of this call. And I'm super pumped. You can see here, and if it's too small, let me know. I'll pop into my actual presentation and make it larger. The let's see, the loan limits for conforming loans, and this is through the whole country. But I've, of course, got California here because that's where we're mostly licensed. You guys, and for Golden One, we only originate loans in California. We have loan limit changes that for the first time in the history has gone over $1 million for conforming. Those are Fannie Mae loans, by, underwritten by Fannie Mae guidelines. I can run that through my system, underwrite the loan myself through the automated underwriting system called DU, desktop underwriting. If you've ever heard it, if you ever heard somebody say DU, that's what they mean. It's basically the automated underwriting system for Fannie Mae. Alameda County now, and the higher cost counties, as you'll see from this chart, Alameda, Contra Costa, LA, Marin, Napa, Orange County, San Benito, San Francisco County, San Mateo, Santa Clara, Santa Cruz. Those are all high cost counties. So you're going to get the most bang for your buck with these loan limit changes because housing prices there are higher. So we've got now a loan amount that used to be $970,800 last year. That was the maximum loan amount for conforming. Anything over that was jumbo, required more down payment and reserves. Now that has gone up a little over $100,000 to $1,089,300. That is now the limit for conforming high balance loans. What does that mean? Well, the basic takeaway is that's a 5% down loan. That's typically with no reserves. Jumbo loans are going to be a minimum of 10% down, It does fluctuate based on, or not fluctuate, but it changes based on the loan amount. For Golden One, a loan amount of 1.5 and 1.89, 300, 10% down. The loan amount. So the loan amount at 1.5 means a little bit higher of a purchase price. What, $1,660,000 or so is going to be a 10% down loan. Write that down, because a lot of people, a lot of consumers think that they have to have 20% down for jumbo. A lot of lenders require 20% down, but we are only 10% down, and we're only 12 months reserves. There are a lot of lenders out there that are 18 months, 19 months, and so on for less money down. It's kind of backwards, because if you've got more money to put down, you probably would. But for us, it's 12 months reserves, blanket, 10% down, 20% down. It's going to be 12 months. There are some nuances to that I'll talk about later. So what that means for us in the Bay Area, Alameda County, Contra Costa, Marin, sorry, my Southern coming out there, San Francisco County, Santa Clara, Santa Cruz, that means this. And I'm going to go back to this chart in a second, so take a picture if you want. Otherwise, this is all public information on Fannie Mae's website. But what that means is this. Now, when you're working on your advertisements to your clients, right, trying to get people on the phone or to at least call you or think about you, you got to give them some numbers, something they can wrap their head around. Show them what the possibilities are, okay? So with the new loan limits, here's an example of what you can offer. Well, what I can offer, to your client. Purchase price, 1.147, so $1,147,000 would only be a down payment of 5%. Buying a $1,147,000 home is only 5% down, and typically no reserves. What does that mean? That's $57,350 down. Most people think they're going to need $225,000 for this type of transaction. That's a huge difference between being able to buy, not being able to buy. So that's why I like that the loan amounts have gone up. And they typically do every year, just because of, housing goes up every year. That's another thing you can tell your clients. These loan amount limits go up because housing costs go up. So not going to go backwards probably. So Santa Clara County, any of the high cost counties, 1.147, you're putting $57,300 down. Your loan amount's $1,087,650. Reserves most of the time, 0. Typically, you can pull about $50,000 from your retirement account. Each retirement account's different. So your clients have to ask their company, where their 401k is held, what can I pull? IRAs sometimes are about $10,000, but again, it's up to the institution. Now there's some tax implications to this, but not if you're borrowing, taking a loan out to buy a home. There's no penalty. There's no early fees, because it's a loan that you're going to pay yourself back. So let's say you took out $50,000 to buy a home, and your interest rate is 4.25% on that loan. That 4.25% interest that you're paying goes back into your own account. Okay, it's not paid to anybody else. So you're paying yourself to use your own money. You can't get better than that. So if you've got someone who's got, maybe $50,000, $60,000 in their 401k, or even if they've got less and they can bridge the gap with what they have liquid, this is an amazing deal. I mean, if you've got a first-time home buyer that's interested in a condo or a townhouse, at 1.1 and some change, this opens up a lot of potential properties for them to be able to buy. Of course, there's the payment to look at and interest rates and all of that. But right now, I'm just talking about the assets to start the conversation. You want to buy maybe it's $1,175,000 house. Maybe they have to offer a little bit more. That's fine. It doesn't go to 10% still. It's going to be whatever the loan to value is to get the loan at $1,089,750. So they would put down the $57,350 and another $20,000. Okay, so it's still doable. I'm happy to run those numbers for you guys. If you've got somebody that you want me to chat with, no problem. So let's say that you've got a client who says, well, I can buy over $1 million home for 5% down. okay, let's say their payment's $6,500 a month. A conservative estimate of appreciation at 4%, and I was using 5 before. And remember that conservative estimate that we saw before is 10%. 4% appreciation on that loan, or that purchase price, I should say, that home, is $45,800 in the first year. Divide that by 12, $3,823 of each mortgage payment, and this is for the first year, it's going to go back into that property as equity. Now, they're not going to see it on an amortization schedule or anything like that, but it's a good way to have them understand, all right, if you're paying, $5,000 a month in rent, or $4,000 a month in rent, or whatever the number is, if you buy a home, yes, it might be a little bit more expensive monthly. And if they can manage that, then fine, right? I'm not talking about having people stress their payment, but if they can manage this and they want to see about how much of that $6,000 payment are they netting in equity, on a conservative estimate, about $3,800 a month. That helps people when they write that big check out every month. That helps give them a little bit of comfort, right? Because they know eventually they'll get this back. Let me go back to this chart here. I want you guys to see the multifamily loan amounts are also increased. So again, for high cost areas, if you are someone that's out of Solano County or Sonoma, this it'll be a little bit different, but your average home prices there are lower. So these should still open up the door for you for a lot of properties for 5% down. So let's say Santa Clara County, you've got someone that wants to buy a duplex, or maybe first-time home buyer. A lot of millennials, especially, are very savvy, financially, and they want to build equity. Maybe they're not as emotionally tied to buying a home as maybe in the past people were. They look at buying a home as, of course, a place of shelter and civic pride and all of that, realizing the American dream, but they're also looking at it as an investment. So maybe they want a duplex. First-time home buyer, I want a duplex. I'm going to live on one side. I'm going to rent the other side out. It's going to make half my mortgage payment. Brilliant idea. What does that mean for a loan? Because typically you're going to need a little bit more money for a duplex. Well, not every time, but for the most part. Well, for conforming, for 5% down, for conforming, duplex is 15% down. My apologies. Most lenders are 30% down for multifamily properties. But for the Fannie Mae loan limit, it's 1.394775. What does that mean for the numbers? Let's look at the second section here. Santa Clara County, the 2-unit / duplex, the loan limit's 1.394775. Owner occupied. Let me stress, owner occupied. If it's investment, there's going to be more money down, but that's a whole different thing to discuss. Maybe on another call, we can do some options for investors, but this is owner occupied. I'm buying a duplex. I'm going to rent the other side out. You can go up to, for 15% down, you can go up to 1.625. It's as close as I can get without crazy numbers to that loan limit. $1,625,000 duplex. You're putting 15% down, $243,750. You've got a loan amount that's just underneath the loan limit. No reserves for the most part. Again, you can pull from your 401k, but you may have somebody that has that money saved. Maybe they're going to buy a single family home. They've got, $250,000 saved for that, but, maybe you see something, a really nice duplex and they want to look into that. When you go to the triplex or a quad, anything over that, 5-unit and above is commercial, completely different chat. It's going to be 25% down. Those are just more risky properties. So that's why there is a increase in down payment. Minimum for both of these, single family home and even 2-unit, 620. This is Golden One's guideline, 620. You can still do a 5, 7, or 10-year ARM. And it's still keeping you from the 30-year fixed rates they're a little bit higher. When you see rates talked about on the news, so they said, well, the rate went from 6.5 to 6.4, went up to 6.8. That's going to be your conforming these loans. That's not going to be jumbo. So don't even think about your jumbo customers subject to those rates that you're hearing about on the news. It's all going to be conforming high balance. High balance is where we live in the Bay Area because it's higher cost of living. Don't really worry about what that means. High balance doesn't matter to you. But anyway, let's look at this duplex. Even at 3%, multifamily tends to appreciate a little bit lower than single family, right? Even at 3% appreciation every year, that's still $48,750 or a little over $4,000 a month in appreciation. So that plus the tenant paying, or the tenant on the other side of the duplex paying, that's a solid financial plan, especially for first-time home buyers. It makes me pretty excited. Maybe I'll go do that sometime. However, let's say there's a duplex and your borrower doesn't have 15% down. We still have an option right here, FHA. Now, FHA in the past has been basically, you've got a little bit, maybe your credit's a little bit sketchy, maybe conforming, like Fannie Mae doesn't like it, they won't take it. Maybe your ratios are higher. So you're putting 5% down and you've got a 47% debt to income ratio, and there's no way we can get that lower. What are we going to do? Not do it? No, we're going to go FHA. It is definitely a more expensive loan. You've got the upfront mortgage insurance premium. Typically the rates are a little bit better than conforming. And then you've got monthly mortgage insurance. So it is still a more expensive loan, but in the grand scheme of a purchase, of even as someone investing, as owner occupied, and also, the duplex investing, it's still minimal compared to what they're going to net in equity. Okay, so it's still a good thing to do. I only recommend FHA if you have to have FHA. If I cannot get you approved conventional and we have to go FHA, that's what we do. But it's never something that I'd jump into first, unless it's a duplex and they don't have 15% down. So owner occupied duplex on FHA, 3.5% down. That means now the loan amount is a little bit less than what we saw, our purchase price, than what we saw in conforming. Okay, why is that? Well, because you've got less down payment, but you've got to keep the loan amount at 1.394775 or below. So a little bit less down payment, so less equity. So the loan amount goes down just a little bit. But this is still a duplex purchase price of $1,443,000 duplex, owner occupied, renting out the other side. You can get into that 3.5% down, and I can use the rent from the other side to offset part of your payment to help with ratios. That is amazing. If that's not setting someone up for success, I don't know what is. Again, pulling money from 401k if they need to. For this particular scenario at 3%, $3,600 a month in equity. I'm not going to shake my head at that. What other investment can you have that pays you back that? I mean, of course, it's not liquid, but what other investment? We can go and, unless you're Jimmy, I almost said Jimmy Buffett, Warren Buffett, I don't have $15 million to throw away and try to see what I could, right? My home is my biggest investment. I mean, I've got 401k and retirement, but, my home is my biggest investment, my biggest asset. There's nothing else. There's no stock that I can invest in that I know of that can get me $3,600 a month. So when you talk about these kind of options to your clients, definitely talk about the realization of equity and what that means when you're looking at a dollar amount. And let's say that you're showing someone a duplex or even a single family home, and maybe that particular area, the appreciation is 6% or 8%. There are some places in the state that are a little bit higher than what I've estimated. But remember, I'm super conservative with this because I don't want to tell someone, well, first of all, we know that we can never say this is what it's going to appreciate for. This is an estimate, right? Very conservative estimate. Okay. Now, let's talk about 10-year appreciation. Now, this is a flyer that I can send you guys. I unfortunately am not going to be able to joint co-market on this. There's no way for me to put my information or your information on here unless we maybe take photocopies of our cards and kind of do it that way, which I can do, sure, no problem. But this is something that I think that you guys should have if you give a packet to people that you meet with, it's a little information packet. That they want to buy in Santa Clara County. or any county in the state, I can pull this number from. I don't manipulate the data very much at all. I go based off of the historical trend of what appreciation is. And basically what I've done, the only data that I have changed is putting the purchase price at the conforming high balance maximum for 5% down. Okay, so will someone please tell me if, and I'm not looking at the chat box right now, so if you're still on and there's something urgent, if you can let me know. Tell me if you can see this slide so that you can read it. It is pretty tiny on my side. I'm happy to pop into my actual presentation, make it bigger. But for, say, Santa Clara County, can you see that year 10, that number above it at 2.175607? Are you able to see that clearly? Can someone let me know? Unmute yourself and let me know.
Yeah, it's small, but I can see it.
Okay. So basically what this sorry, I do have my dog sitting here beside me. Let me go back. There we go. Santa Clara County. Okay. So basically Santa Clara County, if you buy a home this year, 1.147, what's that going to look like in 10 years? This is something that you can talk with your buyers about, or even sellers if you want to, they're going to sell and buy something else. You can talk with them about what is the historical trend of appreciation in Santa Clara County. Remember, it's an estimate. The historical trend for appreciation is 6.61%. Now, remember, I estimated 4, so you can see that I'm still below. But even at the historical appreciation rate percentage in Santa Clara County, after 10 years, you've doubled your money in equity. So that house that was 1.1 is now 2.1 and some change. Okay, if appreciation keeps at the same pace. In 10 years, that's $100,000 a year in equity you're gaining. That makes me excited. I don't know if that's weird, but it makes me excited because I want to go out and tell everybody that. I want to go knock on this apartment building at the end of my street and say, hey, let's look at your finances. Let's see if you can do this. And if not now, when? Let's come up with a plan so that we can set you up for success. I talked about bridging the generational wealth gap. There's a lot of, especially, people that were not born in America, but they're here now. A lot of them, they don't have families that have purchased a home 10, 15 years ago. And, maybe they get passed down that wealth. They don't have that. They're starting from scratch. This makes me want to go out there and talk to every single one of them and say, what can we do? How can I help you? Me and, my realtor partner here, how can the two of us help you and your family realize this type of wealth? Of course, it's long-term, but so are retirement accounts. So that's Santa Clara County. I've got Alameda County here. That historical appreciation is a little under Santa Clara. It's Santa Clara County at 6%. I also popped in 2 more counties here for you guys because I know some of you guys are down south. Hold on. There we go. Make sure that doesn't move. Okay. I've got Orange County. You can see it's a little less in the Bay Area, 5.3. But again, that's the high cost county. So you're talking about, being able to put 5% down and open up your options to a lot more possibilities. 10 years, you buy this home price, $1,067,000, 5% down. You're starting at year 1 and then all the way to year 10. Now you're at $1.8 million. Huh, wow. I mean, that's crazy. I love it. San Francisco County appreciation at 6.39. We all know that's just right up the road here. So it's going to be a little bit more. I can pull this for any county in the entire state. There will be no co-marketing like I mentioned, but I will be more than happy to email this over to you guys. Send me an email. Tell me what counties you want, and I'll pop this over to you. This particular flyer takes me hardly any time to prepare. And it's a general flyer. I can't do by address or anything like that. It is county specific. So it's going to be an average, but at least it gives you a good indicator of what to talk with your clients about. I think if you make a folder or do anything kind of, email attachments out to people, give them one of these. Okay, do let me pause for a quick second. I see there's 9 things in the chat. I'm going to take a quick peek. Just see if there's any. Oh, it's just my contact information. FICO score range that helps them qualify. We need a 620 for conforming. FHA actually will go down to a 580, but Golden One doesn't go that low, so we still need a 620. Let's see. Okay, email me please if you can, because once this call ends, I won't be able to see this chat. So email me separately, even send it right now, jhatano@golden1.com. I think my contact info is in there like 15 times. So send me a quick email and I'll get this over to you after the call. Okay, moving on. Closing cost credit. So while some lenders are shutting their doors down, we're not. We're actually offering a $3,000 lender credit for all purchase loans that have an application date from January 1st, which that's a few days past, to March 31st. This is for them to use towards closing costs. What it does is position them not to have any fees to Golden One. I can't remember which lender. It was one of the big banks that I saw a closing cost worksheet a couple of weeks ago, and their fee, just their lender fee, which is processing underwriting, was over $1,600. In a normal world, ours is only $995, so it's still less. You've got somebody that's pretty tight on assets, especially if it's conforming, 5% down, no reserves, maybe $4,000 or $5,000 in closing costs, and they may not have it. This will come in and help them significantly with closing cost. I'll talk about the lock and shop program next, but it also can be applied to that. The $3,000 lender credit is going to be on the initial application. The buyer cannot get money back, and they wouldn't be able to get money back from us no matter if this was a promotion or not. So let's say there's another way you can get more money from a lender. They still can't receive money back. So any credits from the agent or the lender, or lender and the agent, so combined credits, they have to be used towards closing cost and recurring and non-recurring closing costs. For example, I'm giving you $3,000. The $995 lender fee has gone away. Your homeowner's insurance is $1,000 a year. Well, I've got $2,000 left over. We'll pop that over for that. And the appraisal is $850. I've got another $1,000. We'll pop it over to that. So it does help quite a bit. Let's see. Oh, my little coins. I had it was animation, coins dropping, but I hope you guys remember. Lock and shop. Oh, one thing about the $3,000 promotion through March 31st. That doesn't mean they have to close by March 31st. That means they need an application by March 31st. An application for us is collecting the 6 data elements. For all of my loans that I work with, all my customers, before they have a contract, I only have 5 of the data elements. So it's not considered an application. We don't disclose. So pre-approved loans, even loans that are approved, with a to be determined address, those are still not considered formal applications because they don't have a subject property address. So hold on for that. That's TBD, to be determined. You come to me with a contract March 31st. They still get the $3,000 credit, even if they close in April. Okay. Maybe that'll get extended. Last time we did this, it was a $2,000 lender credit, and we did extend it a couple of months. So we'll see. If we get really good traction with it, I think Golden One may extend it, but it just really depends. So make sure you're talking about that when you're talking to your clients about me at Golden One, that you know already what I can offer them. Lock and shop. Now, we came out with this recently. I don't think it's really maybe we're a little behind the 8 ball on it, but it does take a long time when you try to get these kind of programs out there. There's a lot of legal stuff you have to go through as the lender. So it took a little while. We saw the need for it, and then it took a while to get it established. We do have a lock and shop program. So basically, it's super easy. We lock your loan on a to be determined address. Now you have an application. Well, no, you don't. You don't have an application. But you'd still probably get the $3,000 if we've got an address by March 31st. You're going to have to anyway on this program. So we lock you. Let's say we locked you today at 5.5% on a 30-year fixed. You've got 30 days now to shop, find your house, and then you've got 30 days to close. But let's say you do that, you need another 15 days. That's fine. We will allow one 30-day extension after that. So in a sense, you've got 90 days, potentially 90 days with a rate that's already locked. Now, there is no joke here. Those rates are going to be a little bit higher. If not higher, the cost for that rate may be higher. For example, if 5.5 today is at 0 points, but you're going to do the lock and shop program, 5.5 today may cost a quarter. So then we have to look at what we think rates are going to do. Do we really think that, it's a good time to lock it now or wait? We do allow for one time to float down if the market drops. It's got to drop 75 basis points. Not that you need to know exactly what that means. I'll leave that up to me. I'll educate your buyer on that. Basically, if the market tanks 75 basis points, we will allow them to drop down to the lower rate one time during the lock and shop process. I'm not really seeing much traction on this right now because interest rates are starting to go down. So if you call me and say, I want to lock on your lock and shop program, I might tell you, well, okay, but let's wait a couple of days. Let me see kind of how it's going. Because remember, we're projecting to float right now, carefully, but to float. So now to talk about what's Golden One, what's different for us, what's our niche. We have lots, okay? And I'm not saying that we're the only lender that does all of this, okay? There may be other lenders that do maybe the same type of thing, but the list I have is for what we do is significant. Tax returns. So we only require tax returns if the borrower is self-employed or they have rental properties and we need to use rental income to qualify them. Then we will ask for tax returns. No other reason to ask for tax returns. I would say about 60% of the time, people, even though I will just ask for W-2s, they will upload their tax returns and I end up putting them in a different folder because I don't need them. That's nice because, there's a lot of stuff on tax returns for salary borrowers, hourly borrowers that we don't really care about. It doesn't matter. It doesn't impact their income. W-2s and pay stubs, that's what we'll do. For jumbo loans, we will go up to a 45% debt to income ratio on most scenarios. Now, I can go up to a 50, but that's got to be with 25% down, high FICO, things like that. It could be maybe there's some rental income or rental that's maybe popping their ratio over a little bit, but if they're putting significant money down, then we will go over the ratio of 45%. So that's great. That I have seen some success with that, especially last year. I saw a great deal of success with us being able to go higher on ratios. The reason it's capped at 45 is because the mortgage insurance company will not, there's several of them, but none of them will go over a 45% debt to income ratio on jumbo loans. Now for conforming loans, so underneath the loan limits I've showed you guys and FHA, I can go to a 49.99 as long as when I run the loan through automated underwriting DU, we talked about before, desktop underwriting. If I run it through there and I've got a 49.99% ratio, but desktop underwriting gives me an approved eligible, good to go. No additional reserves needed. It likes the loan file. It likes the credit history. It likes the assets. Maybe they've got, 20 grand left over after closing and it feels that secure. As long as I get an approval, then I can go over that. There's no add-on to the rate. We don't adjust for any of that. So keep in mind, there are some lenders, especially the bigger banks, tend to max jumbo at 43. One thing to note, for conforming, if you're doing 5% down, we really want to see that ratio at 43%, okay? Because you've got less money in, so there's more risk to the lender, but also because we want to make sure that we're not putting the borrower in a position to potentially lose their home or have stretch their payment. So we do ask for a little bit lower of a ratio on those 5% down conforming loans. All right, 43%, that's still generous. The rule of thumb that you'll hear probably forever is 30% of your income housing. Yeah, but that's not really realistic. Student loans, car loans, that kind of stuff kind of pops that number up in a lot of cases. So it would be 43%. We have a professional program that we will allow an employer to offer a second mortgage up to 90% combined loan to value. So that means the borrower's putting down 10, and then maybe the employer is giving a small or a 10% second mortgage. Typically, lenders don't do that. They don't want to see an outside second mortgage. They don't want to deal with it. It's not going to happen. But for some situations, we will allow that. Up to $1.5 million on the loan amount. For condos, sorry, I didn't see that word. So that's for condos. Condos, that's a whole different beast. Maybe another call, we'll go over that. I'm going way over the time I'm supposed to. I know only for an hour. So if some of you have to go, go ahead, but I'm going to keep going here. Interest only loans. We have interest only with the 5/6 arm and 7/6 arm, 25% down, up to $2 million. So if you've got somebody that's more cash flow sensitive, that's a great loan for them. Interest only loans are not bad, especially when you're talking about areas that tend to appreciate more. But that's why it's 25% down. We're not going to give somebody an interest only loan, 5% down, that we think that's the only way they can qualify. So there are some caveats to this, but it's still a great offering. We go up to $4 million on jumbo loans. We call them super jumbo loans with 20% down. We can price on some of our conforming high balance loans that tend to be the 6.5% 30-year fix that you see on the news. In some cases, I can price give jumbo pricing on those loans, which is like a point lower. But of course, they'll have to be, jumbo category. So maybe 10% down, things like that. But in some cases, it makes sense if they've got it and we can give them a better rate. All condos are limited review. If they can pass limited review, we'll loan on them. I've already talked about professional loan program. Delayed financing. That has to do with if someone pays cash for their home within 6 months. If they want to do cash out refi, we will actually give them purchase pricing rates. Refinance rates tend to be a little bit higher. Non-permanent resident, we are lenient on most visa statuses. You hear somebody that's got a funky something going on, give me a call. With departing residents, if they've never rented, they've never had experience with landlord history before, we can use the rent from the departing residents to offset the current mortgage, principal and interest, tax, insurance, association dues if they have it, up to 75% of that total rent. There's a little bit you got to leave for a vacancy factor, but that's pretty generous too, because that can help someone qualify with 2 mortgage payments. If they rent it out, we got to have a lease, 12-month lease, and we have to have a copy of the security deposit deposited into their checking account. We most of the time don't do a verification of rent. If you've got someone going through a divorce, but it's not finalized yet, and they've got just a settlement agreement, as long as it's notarized, we won't ask for a divorce decree. That's huge because people don't tend to like to divulge all of that personal information, so we don't want to know about it either. FHA loans, 3.5% down, that's pretty standard. Upfront underwriting pre-approval on purchase loans. If I've got somebody that's self-employed, maybe restricted stock unit income, something crazy going on, I can send that over to my underwriter before going on under contract with a fully approved credit income asset underwritten loan. No finance contingency. That's very important. I know that finance contingencies are starting to make a little bit of a comeback, but if we can have your client not have to have one, now they can still have appraisal, inspection, whatever, due diligence, all of that, but just not a finance contingency, that's still going to put them apart from the other people potentially making offers. We do home equity lines of credit on investment property. So they're going to rent this property out, move into a new owner-occupied property. They've got $250,000 equity that they want to pull for the down payment. Sure, as long as they qualify, yes, we'll do that. We're lenient on RSU income. We're a little bit more gracious to borrowers than some of the bigger banks that allow for restricted stock unit income. These are for tech companies. Local underwriting and processing. Everything's out of Sacramento. We're a direct lender. We don't broker out or anything like that. So we draw our own documents, fund our loans from our corporate office in Sacramento. Reserves. Let's see. So some of you are still sticking around. A couple more minutes, we're almost done. Reserves. So again, I'd mentioned this is going to be for jumbo loans, not conforming or conforming high balance. Reserves could be up to 18 months, depending on if the borrower has not ever had landlord history, we can still use the rental income to offset, but we might need a little bit more in reserves, okay? Just because we want to make sure, again, this is to ensure that they're financially set so that if they have any problem, maybe the tenant doesn't pay rent and they've got a hard time getting them out, they've got 6 months additional reserves to make that mortgage payment if they're missing out on the rental income. So we might ask for a little bit more, but typically it's not going to go past 6 months additional. If they have landlord history, then we only ask for 2 additional months. So that's significant. I already talked about that. And question and answer. Oh, I will say these are some of a couple that I've had lately. Are loans assumable? And you guys, a lot of you actually emailed me about this. Great thought process around it. It was beautiful, but I'll tell you why it's really not going to be a big thing. So all these people that had, 2.75, 3% interest rates, and some of them 30-year fixed, but some of them on ARMs in the last couple of years, maybe they want to sell their home and they've heard that someone else, a buyer, can assume that mortgage with that mortgage rate. Well, it sounds great and it'd be great, selling feature. You could put it on your yard sign, 2.75%, 5 years. The reason that's not really a thing is because for ARMs, they're not assumable until after that initial period, right? So if it's a 5-year ARM, you got to be in year 6 to be assumable. Well, that really defeats the purpose. And fixed rate loans are not assumable. So again, good thought, but it's really not going to be a thing. I don't think that you're going to want to spin your wheels on. Talked about the divorce. We don't have to have the full thing. We don't count if someone pulls 401k loan to put for their down payment. We don't count that payment back into their 401k against them. Okay. All right. Now Q&A. So. Ra, if you want to step in, go ahead. If you want me to do, whatever. Usually Mike does this part, but I'm more than happy to manage it. Okay, so I'm just going to scroll down. I already did that. My contact information. Let's see. I'll assume the y-axis is percentage, right? The spread now is high. Email me later if you want. I don't remember which slide that's for. FICO is going to be minimum 620. Let's see. Blanca, email me if you want that sheet for Riverside County. Thank you, Sandra. Yes. Oh, San Francisco. I'm in Oakland. So I have an office in Oakland and San Jose, but I'll go anywhere. If somebody wants to meet in person. Alan, please email me and I'll send you LA County. Mark, Sacramento County, email me if you can. PMI for 5% down. That's a good question, Ritu. Thank you. Mortgage insurance is relatively inexpensive right now. FHA tends to be a little bit more monthly, but mortgage insurance for conforming high balance and conforming loans, if I just guess, it's based on the credit score. It's a percentage of coverage. So if you put 5% down, it's a little bit higher. 10% down, 10.01%, it's a little bit lower. A couple $100 maybe. The good thing about conventional mortgage insurance monthly is it's not forever. It is cancelable. As soon as that buyer reaches 78% loan to value or 80% loan to value, then they can call me back and say, hey, Jody, I think I've got my 20% or 22% equity. I want to drop the mortgage insurance. What do we do? Okay, we will contact the servicer that we use, Devonville, and we'll say this is what we want to do. We will have a new appraisal done to confirm the value. Borrower has to pay for that. We're not allowed to. Borrower has to pay for that. Get the value in, and that person's got the equity, then the mortgage insurance then cancels. Otherwise, if they don't ever call, then it will, and they keep their loan for forever, it will eventually drop off based on the amortization schedule at the time of purchase. Probably going to be around 10 years for them to basically follow along the amortization schedule and hit that 20% equity. That's going to be based on the purchase price, from long ago. So it's always important to contact me back if you think that you've got the equity there. All right. Okay. Blanca, Bank of America doing that too. I'm not sure what, but possibly we're not the only ones that do some of this stuff, but Let's see. I think we do it the best. Yes, Blanca, please email me. I cannot send out the presentation anymore. I'd have to go through compliance and all of that stuff, and it takes a while, and no, I can't do it, but you can take pictures of my presentation. Let's see, LA County, Blossom, please email me. Please email me, because like I said, after this call, I won't be able to see these email addresses. So please email me the counties that you want those sheets on. Sonia, how can we get the replay ASAP in the PowerPoint? The Mike and Ra can let you know whenever it's going to be on replay. It's recorded, so once they get it, and they have to do a few things to it to have it ready, but it should be out there soon. Blossom, resident San Visa, we're super relaxed, so give me a call if you've got a scenario you want to run by me. Roger, I'm sorry I can't share the slide, but it will be up on YouTube. Oh, Rod just let us know. It'll be up on YouTube by the end of the week, okay? And then there's the subscribe button there. And if you guys don't have a ton to do and you want to take a look at several different recordings that Mike has put out, a lot of them are mine, a lot of them are his. Just help give yourself some more education going into 2023. I will wrap it up. We are way past, but I appreciate everyone spending time on this call, taking the information down. I want to be a part of your success in 2023. I'm committed. I'm here. I believe that, it's going to be maybe a little bit challenging the first part of this year, maybe the first quarter, but I think it's going to pick up. And I think that we're going to have an amazing 2023, December 31st or December 30th. I want to do another call with you all, and I want to say, look what we did. Okay. If you've got any questions of some of this stuff you don't understand, you want some clarification, please give me a call. I'm happy to meet for coffee, take you to lunch, whatever. Just let me know. I'm always here for you. Evenings and weekends encouraged. Real estate doesn't sleep. And even though I do, I live and breathe it. So give me a call anytime. Mahalo, Blossom. Thank you so much. You guys go forth and conquer. All right. Have a great day. Thank you so much.